What we said on Monday is that looks like somebody's getting margin calls, right? There's a hedge fund in trouble. There's something going on here, but somebody's being forced to liquidate treasuries to cover an asset trade of some sort. 2 days later, we find out that there's a problem with this basis trade now going on, and there's this unwind that is now happening with these leveraged trades. So this unwind risk is the threat that we've talked about for some time, that, that's the big concern for the markets.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So we told you often that, markets are markets. That's one thing. But if you really want to focus on the big risk to worry about, it always comes out of the credit market somewhere. And so far, credit markets have been fairly tame. We haven't seen big jumps in credit spreads yet. They've risen a bit, no doubt. When you ever have this kind of market stress in the markets, you're going to see credit spreads pick up a bit. But they're not at worrisome levels yet in terms of the rise in yields. But they are rising. But the one issue that is coming up is, and again, we've seen very sharp drops in bond prices the last 2 days. We're going to see it again this morning. Yields are going to be up probably somewhere around 2% this morning on the 30 years. So you're going to see a very big jump in yield statement. This is a function of what's happening in the bond market, and this is the function of what this is called the basis trade. So let's talk a little bit about what the basis trade is. If you're not familiar with it, and most people aren't, it's kind of one of those obscure things that happens in the background of the bond market. But it's basically it's an arbitrage strategy. And it's very popular for hedge funds, companies like Citadel, Millennium, Point 21. In fact, these are hedge funds that have massive regulatory assets, and they've grown over the last 3-4 years. These assets have absolutely exploded in these hedge funds, particularly companies like Citadel, which basically takes the other side of the trade for everything coming out of Robinhood, as an example. So, but you see this massive surge in these regulatory assets. So, you think about what blew the markets up in 1998, it was long-term capital management. And back then they had about $100 billion in assets. Now we're talking about multiple companies with hundreds of billions of dollars in assets that are sitting out there. Well, one of the very popular arbitrage strategies, way to make money, is called this basis trade. And this happens particularly in the U.S. Treasury market. And basically it's just the exploitation of the difference between the Treasury's price in the cash market and their futures contract. So again, futures kind of trade on their own relative to kind of what expectations are, kind of like commodity futures, oil, gas, gold, all those type of things. That's what the futures market is doing. But, theoretically, right? So let's just take a real simple example to make this easy to understand. Let's say that you've got a gold bar, and in the futures market, it's trading at, $3,000 an ounce, just to pick a number. But you may go down to a dealer, and the dealer says, yeah, I'll give you $2,900 for it, because he's got to make some money on it somewhere as well, right? So you're not going to necessarily get that the futures price in the market versus the cash price that it'll settle for right now. That's a simplistic example, but there's a $100 spread there between those two. So what if you could figure out a way to pick up and make a trade on a consistent basis and just keep picking up that $100 spread every time you do it? Well, that's what this is what happens in the Treasury market. And so when you have a lot of assets, and maybe I don't deploy all of my cash at one time and private equity investments or whatever it is, so I've got cash sitting over here. Well, I can deploy that cash in the Treasury market, safe asset, right? We talked about the yen carry trade before, where you short the JGBs and buy the U.S. Treasuries, capture the spread between the yields. That's what this basis trade is. And it's a huge trade that is going on every single day in the market. So, and so this is what's happening. This basis trade is basically coming under a massive amount of pressure right now because of changes in yields and what's happening. And so you're getting this increased selling pressure in the futures, So when hedge funds execute these basis trades, they short large volumes of these futures. So as this yield move goes, the more they have to short. Well, if they get caught on the wrong side of the trade, this becomes problematic very quickly, and there's a lot of liquidity tied to this. And so so when we start talking about, kind of the issues of risk in the markets, this is something that, we had talked about before. So TBAC, which is the Treasury Borrowing Advisory Committee, they just wrote in January of this year that anecdotally 20 times leverage appears to be a good approximation of what's happening with those trades. So think about that for a moment, right? I take $1 million and I'm leveraging it 20 times in the market. So if something goes wrong, you can have a very rapid unwind of this situation. So on Friday, bonds, the bond yield was below 4% on the 10-year Treasury, which is where it should have been going given tariffs and the potential for a recessionary impact in the economy, et cetera. That 10-year Treasury yield below 4% was going in the right direction. It was hedging off that risk for an economic downturn. Now, Monday and Tuesday, yields have absolutely exploded higher, well outside the move in Treasury yields. That's a function, and what we said on Monday is that looks like somebody's getting margin calls, right? There's a hedge fund in trouble. There's something going on here, but somebody's being forced to liquidate treasuries to cover an asset trade of some sort. 2 days later, we find out that there's a problem with this basis trade now going on, and there's this unwind that is now happening with these leveraged trades. So this unwind risk is the threat that we've talked about for some time. That's the big concern for the markets. It's not just tariffs aren't the issue. Tariffs are one and done. Once we know what these are, the markets can price them in and we can move forward. That's okay. We still have uncertainty around tariffs, obviously, today with China retaliating with an 84% tariff hike this morning on top of the 104 from us on them last night. So this is just tit for tat. Again, that's certainly contributing to the uncertainty of the markets. But this sharp rise in yields has much more far-reaching impacts on liquidity of the markets, on stability of the markets. And again, when you talk about what's the lifeblood of the market, it's not stocks, it's bonds. Everything revolves around credit. So a very sharp rise in yields all of a sudden disrupts credit markets. It disrupts borrowing markets across the board. I mean, there's many impacts to this that have a much more far-reaching impact on financial markets outside of just tariffs. And again, this is one of those events, as we've talked about repeatedly in the past, is that's the thing we want to watch the most. We want to watch the credit markets because it drives so much of what happens. Now, this is an early event right now that we're talking about. This isn't, oh my gosh, go panic and sell everything you own. I'm not saying that at all, but we need to be watching this very carefully. The last time that we had these types of issues in the credit markets were in 2019, 2020. Both times the Fed had to step in and start to bail out these hedge funds. And remember, we talked about in 2019, in September, we started having this big blowout in the repo yields. And overnight borrowing was running at 10% yields. And we're like, something's not right here. Something's not happening. And we had to see the Fed step in to start, solving the repo problem at that time. That was basically a function of the basis trade as well. 2020, we saw the same thing. Markets completely collapsed during the pandemic. Fed had to step in, start bailing out the markets. Well, here we are again. And we look at this and we go, well, why do we keep bailing out hedge funds? It's a good question. Don't have an answer for you. But the impact, again, and this isn't a new thing, right? We go back to 1998. That was the first hedge fund we bailed out, was in long-term capital management back in 98 and 97, 98. So this isn't unprecedented. The magnitude of these bailouts are getting dramatically larger because, again, once you start looking at the regulatory assets that these funds have and start talking about 10, 15, 20 times leverage on those assets that are being traded, you start to kind of get the magnitude of the potential risk to the bond market and ultimately to the economy, to the stock market, everything else. Because once the liquidations have to occur, and we've been seeing this for the last 2 days, so these big moves on Monday and Tuesday in the markets, this 1,000 points down day, 1,400 point down day, is very similar, to, by the way, to what we saw in 2020, right? We shut down the economy in 2020, saw this massive shutdown, and markets were dropping 1,000, 2,000 points a day back then. We're seeing that same type of impact over the last couple of days in the markets, these very, very sharp downturns in the markets. That's a function of this unwind in the credit market that's happening, right? It's this forced liquidation that we're seeing across the board. And again, you can kind of almost tie it back to last Friday. You know, we saw this on Friday, markets were under pressure, and you almost can see that on Friday night after the market closed, people were getting phone calls saying, hey, you need to cover your line of credit on Monday morning, right? We're calling in your margin, whatever it is. And on Monday, that liquidation started. We saw it all day Monday, we saw it all day yesterday, even despite the fact we had these kind of brief attempts at rallies, they weren't able to hold into it. So we'll kind of keep you up on this. We'll talk more about it with Michael Leibowitz tomorrow on the show. But again, this is the thing we want to watch. But if there's going to be a move by the Fed, it's going to be because of this, not because of tariffs, not because of recession concerns. And this is the type of thing where they don't care about inflation anymore. This is about solving financial stability in the markets, which is their number one criteria.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.